Hello, everyone, and welcome to another session of HR Power Hour with EOS Human Resources Consulting. My name is Sarah Skoronsky. I am the Principal Consultant at EOS HR, and we're so glad that you're joining us today. Today, we have a special guest with us as we prepare the next phase of the COVID-19 pandemic is getting our PPP loans and our EIDL loans, which are both SBA loans, and people are starting to receive those. The second round of funding has just been granted on Friday. And so today we have our guest Hannah Smolinski with Clara CFO Group, and she will be discussing the best way to utilize your funds in order to get the most forgiveness and not have to pay those funds back. I met Hannah via an online group that I'm part of, and she had a tool that I was really impressed with and I thought would help out our clients and help out our audience in budgeting for the PPP and the EIDL loans and being able to maximize that forgiveness. So with that, I'm going to turn it over to Hannah so she can introduce herself.
So I do virtual CFO services for small businesses. I focus on mostly small businesses making less than $5 million in annual revenue. But I come from a public accounting background and then started this business about 3 years ago. And I've been serving clients one-on-one in kind of a strategic financial advisor role. So I kind of sit between your bookkeeper or your accounting team and your tax CPA and help small business owners really just with their financial strategy and helping them figure out lots of different things like when to hire and how to use the PPP money and when to open a new location and things like that. So
all those important things.
Yeah. So that's kind of my role as a virtual CFO. And then right now, just everything has been taken over with the PPP program and then just trying to figure out the right resources for employers right now as people are facing everything from, having employees walk out to not being able to operate at all to doing virtual and moving everything to a different situation. So, it's a complex environment right now and we're just trying to decipher everything as much as we can. So I'm happy to be here as a resource and hopefully we can answer some questions.
Yes, thank you so much for joining us. So today we are going to be talking about, we're going to start with the CARES Act Part 2. As it stands, it was signed into, I believe it was signed in today. I got notices that the SBA is going to start reviewing the PPP loan applications starting on Monday. So here we go for the next round. So just some of the high-level highlights of this round of the CARES Act. There's $310 billion have been allocated to the PPP. This is 60 billion of that have been set aside for small lenders. This is for credit unions and local banks. 50 billion are for the emergency injury disaster loan, that's the EIDL loans, and 10 billion of that are going towards the grants. So that's the up to $10,000 in grants, and 75 billion for hospitals and healthcare, and 25 billion for the COVID-19 testing. So we're really going to focus probably most of the time on that top one, but we'll spend a little bit of time talking about the EIDL loan as well. And just as always, a disclaimer, whenever we're talking about this, we're not lawyers, and in terms of tax advice, you want to make sure you're talking to your CPA, your tax advisors, but we want to try and explain this information to you in as easy to understand terms as possible, because there's so much information out there, as Hannah was saying, it can get really confusing. So we want to make sure that we get your questions answered.
Yeah, and if I can add to that, Sarah, too, like on the PPP program or the PPP program or whatever you call it, the last word is program. It is still kind of in an evolution. I mean, even though they have funded already almost 350 billion, and then now they're doing another 310, there are still additional rules coming down. So I will be we will be trying to answer the questions as best as we can, but we also kind of understand where there are gaps and there's potentially further guidance. So I just want to kind of give that disclaimer at the very beginning as well, because there is still more to come on all of this.
Okay.
Yeah.
So, Hannah, do you want to talk a little bit about just the general rules and application of the PPP and who's eligible and what we know so far about it, and then we can get into some specific FAQs.
Sure. Yeah. So the payroll protection program, for people who aren't aware about it or maybe have heard a little bit about it but aren't sure whether or not it's for them, it is mostly a program that's trying to sort of help employers maintain status quo from what they were doing in January and February of this year through to June, because clearly there's been a huge economic disaster of things that have happened. And we are basically, what the government realized is that if they didn't start to help small businesses, then potentially all of these people would there'd be tons of employees that would be laid off and they would have to go on state unemployment. And so the government designed this program really to help kind of ease the tension off of the state unemployment, I guess, the run on the state unemployment coffers, essentially. So we are allowed to apply for this program if we employ people, or even if you are self-employed as just a single member LLC or even a sole proprietor, where you can basically get a paycheck kind of grant if you do the right things and jump through the right hoops. So this is specifically designed for smaller employers. You may have heard of all the hoopla around the larger companies that were getting this program. They've since kind of made it more clear that this is not intended for large employers. This is meant for mostly people who have less than 500 employees. And then what we do is we actually look at what employee costs were for the past year, or for the 2019. And then we take the average of that, essentially just dividing it by 12, and then we can get a loan up to 2.5 times that average payroll. So this can go up to $10 million. That's the max amount of the loan. But for most of us, and probably most of us on this call, it's going to be significantly less. It might be, as low as 10,000, and then we might be seeing up to $1 million in some cases. But you could request up to 10 million if you meet those requirements, and that's your 2.5 times your average monthly payroll. And, just kind of going through some of these bullet points here. There's a couple nonprofit eligibility things to look at there. I don't actually deal too much with nonprofits, but it's good that you've listed that there. And then independent contractors are not employees, so they are not included in payroll costs. And that has been really confusing for people. And some people applied thinking that that was the case. So we might get some questions around that. And then independent contractors and sole proprietors, like I mentioned, can apply for the PPP loan. So this is really interesting, because sometimes they're the ones that get forgotten in all of this. But my guess is, since they have an HR ear, that maybe there's not too many sole proprietors on the call today. So let's see here, what else? And then payroll costs need to be limited. We can't pay people salaries more than 100,000 and have them included in this. So we can limit their salaries to 100,000, but say you have somebody who's making $200,000 a year because they're in upper management, we do have to limit their includable wages for the purposes of the PPP program. So I think, that probably covers kind of the high level.
Yeah, definitely. And then shifting right into, I think, what a lot of people are anxious about. I'm watching the Q&A start to roll in here. People are really anxious about how do they get it forgiven. And so again, let's talk about the high level of the forgiveness, and then we can go through our questions that we have, and I'll make sure that all of the questions on the Q&A get answered as well.
Sure. So the thing that I like to think about with, so the big thing about the PPP program and why everybody's so excited about it is that there is a potential to have 100% of the loan forgiven. And that means just straight up forgiven. You don't have to pay anything back. It's not taxable as income. Like, it's just wiped away from anything. And it's basically just free cash from the government. So that's why it's got everybody all, all really excited about it.
Yeah.
And very anxious to figure out how we can get this money forgiven. So the main rule and the thing that we have to kind of keep in mind is that this money is really intended to help employers keep their employees employed.
Right.
So that's what we need to just kind of keep this all from, like, really understanding just the mission behind this whole thing. And that's going to help us answer some of the nuances and some of the little questions here and there. But in order to get your loan forgiven, the rules say right now that you need to spend at least 75% of your loan amount on payroll costs. So that's kind of the big overarching rule. And what it doesn't want you, and the reason that they're keeping it that high is they want to see that you don't lay people off and then bring them on at the very end of the period. And then this money is intended to cover an 8-week period. So once you get the money, you're supposed to spend the money within 8 weeks. And so this is kind of where it got me a little bit like worried that maybe some people might not know all the rules. So that's one of the reasons why we're talking today, so we can kind of get everybody up on that. But essentially, in order for it to be forgiven, you need to spend at least 75% of the loan amount on payroll costs. And then you have the other 25% can be spent on other allowable costs, things like mortgage interest, utilities, rent, if you're under a lease agreement, and potentially interest on certain other debt obligations as well. Like if you have an auto loan for your business, or you have other things like that. And you can't have, 75% of it on other allowable costs and only 25% of it on payroll. You have to have at least 75% of the loan being spent on payroll costs.
Okay. So let's dig in and talk about what is payroll. Like, what's covered under that umbrella?
Okay, so payroll costs, this gets a little bit confusing, and but they have provided more guidance around this, so I think we can go over it pretty easily. So payroll costs includes gross wages. So if you're not, worried about the fact that your employee had, a certain amount taken out for their federal taxes or their state taxes or anything like that, you include gross wages. And then you include your state employment taxes. Now, the thing that you will be specifically excluding is federal employment taxes. So you're going to not be adding in the employer side of FUTA and FICA. Okay. So that means Social Security and Medicare are not included from the employer side, but the employee side is included because that's included in their gross wages.
Right.
And then you can also add things like health insurance. Health insurance premiums that are paid by the business are considered payroll costs. You can include retirement contributions. So if you're contributing to, an IRA or a 401k, something like that, that's company sponsored, it can be included in payroll costs. Also other benefits. So if you have other kind of group insurance, say dental insurance or something else, even I think really pretty much any employee benefit can be included in a payroll cost. I don't know if any employee—
That's paid by the employer, right?
Yeah, that's paid by the employer. I don't know if you've seen any benefits that have been specifically excluded, but I haven't.
I haven't seen anything excluded.
Okay.
So,
Ones that might be a little bit fringe are if you give your employees money for like a stipend, if you give them a stipend for, them to pay their own health insurance, or if you give them a stipend for maybe their cell phone or something like that, that's a little iffy at this point. I would probably exclude that without some specific guidance around it. I wouldn't count on it being included, I guess, at this point. But that's going to be pretty minimal probably compared to the main payroll costs.
Okay.
Yeah, so I think that's everything on the payroll cost side. Let's see if any of those questions specifically talk about—
Let's see. We have some questions about if they're trying to figure out the number, how are they calculating the head count, which I think we're going to talk about,
Mm-hmm.
have on our list. Um, so Karen asked about which part is forgivable. So workers' comp, is workers' comp forgivable?
Yeah, workers' comp would be considered an employee, well, an employer cost. So that would be a payroll cost.
Okay.
Mm-hmm.
Um, so we got that. And then, let's see. So a little bit about the timing is when, so they have to, if once they receive the money, they have 8 weeks to use the funds.
Mm-hmm.
So, but don't they also have to use them by a certain date as well, or is it just 8 weeks from when they receive the funds?
It's 8 weeks from when they receive the funds, and there's been a lot of questions around. Okay, when is the actual start date? So the documents talk about the quote unquote loan origination date, and a loan origination date is the date that the money hits your bank account. So if it came into your bank account today, your loan origination date is 4/24. And this date, so basically you would have 8 weeks from today to spend the money.
Okay. And what about, you said the 401k, if they're paying into the 401k, that can be part of the forgiven. But what about the administrative costs for the 401k? Can that be forgiven?
Um, as far as I can tell, no. It might be able to be considered like a utility of some sort, but I would probably not count on that being forgiven.
Okay.
And this is kind of where we get into that, hey, we're kind of still waiting on some further guidance. So we will see as people continue to ask questions. Some of this is going to get, sorted out a little bit more, but so far there's been no word on that piece.
Okay. So, Nakia, when we find out, we will make a note to get back and make sure that that's posted with the rest of the information, because that's a great question.
Yeah, it is.
Um, so 75% of the funds are used for the payroll. We talked a little bit about what the other 25% can be used for. So that's it's not any operating costs, but it's those specific costs like utilities and um, and the mortgage and the rent. So if people are working, if people have virtual people already that are working from home, is there any expenses that can be accumulated or forgiven in that way?
Do you mean like what type of utilities they might have or what
Yeah,
type of expenses, not having a physical office space,
yeah.
rent or whatnot? My thinking is that probably internet will be a big utility that will be able to be covered. And then this is again one of those places that we're hoping for a little bit more detail on. My understanding is that potentially phone and internet will both be able to be done. And then also you don't have to spend 25% on those other fees. So if your payroll potentially covers 100% of the loan, then that's fine. They're just giving you an allowable up to 25%. So if you only spend 25% on payroll, then you have this other way to potentially get more of the funds forgiven. So if you were in a situation where, because I run into this a lot, where maybe you have a virtual office and you don't really have some of these hard costs that are included in this, the allowable costs section,
Mhm.
you could still potentially get, use that money for payroll and it could be fine. So
Okay.
and then, whatever you don't use, this is kind of a big deal. There's actually some pretty harsh language in the law that's basically says that this money should not be used for anything fraudulent. And they're kind of calling anything that's not used for payroll or these other allowable costs as fraudulent.
Mm.
So you need to use this money for its intended purposes. And I just want to make sure that that's really clear because nobody wants to get in trouble for potentially using these funds on whatever the heck they want for their business. And then they come back and they get in trouble for whatever reason. I mean, that could potentially be hard to prove, but I just kind of want to lay that out. So if you don't say you use 75% on payroll, but then you don't have any other allowable costs, you could potentially just take the rest of that loan money and pay it back right away.
Okay.
So, and then, you know, you can decide how you want to do that as a business owner from there.
Okay. And let's see. So so basically all the money has to be spent in that 8 weeks. So if they don't spend the money by the end of the 8 weeks, they should plan on whatever isn't spent giving that back, or?
Well, they don't have to spend the money during the 8 weeks, but if you want to be eligible for forgiveness, you do. Like you at least need to spend the 75% on payroll. And then whatever you do spend, so let's say you spent 75% on payroll, and then maybe you spent another 10% of it on other allowable costs, that would give you 15% of it left over that you could still hold on to and use for payroll, but it might just be outside of the 8 week period. That's fine. You could hold on to it. Just that 15% does not become eligible for forgiveness. So in that situation, it you know, is truly a loan. That remaining whatever does not get forgiven turns into this loan, or it is a loan. And the thing about this loan is that it's a short term. So it's a 2-year repayment period on this loan. So that's why people really want to try to get this amount forgiven, because this could be a serious amount of money that needs to be repaid if you don't use it the right way. I mean, you know, $100,000 try to repay $100,000 in 2 years is pretty aggressive. So, I mean, for most small businesses, so it's, you know, it's something to definitely keep in mind.
Mm-hmm. Okay. Um, so let's skip down to the calculating by head count and hours, and what's the best way to calculate um, the people that are working, and making sure that you're meeting the requirements here.
Yeah, so I mean, what I would do, and this is what we'll send out to everybody afterwards, is I've created a spreadsheet that um, allows us to budget for some of this. What I would use to calculate my costs is I would first look at my payroll reports. So I would be looking at actual dollars spent first to see what I think I'm going to spend over the next 8 weeks on payroll. And I would pull those correct numbers, you know, pull the actual wages of what I'm going to be paying people. And, you know, I'm going to have to do a little bit of planning on this side to make sure that I'm spending enough. But I'm also going to look at my head count from February 15th, whatever my head count was at February 15th of 2020. And I'm going to look to see how many full-time employees or full-time equivalents I had at that point in time, because ideally you're keeping your full-time equivalent headcount through June 30th if you want to apply for full forgiveness. Now, if you have a reduction in full-time equivalents, you could potentially have a reduction of your forgivable amount as well, kind of pro rata on that. So we're looking more at dollar amount, but then we do have that head count that we need to consider. I don't know if we're really caring too much about hours, except for the fact that hours kind of go into your full-time equivalent calculation. So I think that's what so it's kind of all. Calculate a little bit of everything.
Is the calculation by headcount hours or money? Yes.
Yes.
Yes. Okay. All right. And Ruth, I know you had asked that question. If you need a little more guidance on that, please let us know, and we'll try and give you some more information. The next one here is somebody asked a question about PEOs, and is the money that you're paying to a PEO forgivable?
Yeah, and that's the one that I think is probably not. Yeah, probably.
Because that's considered a business expense to the employer rather than a payroll expense.
Yeah, that's what I would think. Yeah, I mean, it might be something that you can have, you know, forgivable for your taxes. I mean, deductible for your taxes, but it might not be forgivable underneath this specific program.
Okay.
Unless for some reason they come out with other guidance, but right now my assumption would be no.
Okay. And what if you get the PPP, but you're not in a situation where you actually can open back up right away, if there's just no business out there for you to open up for?
Yeah, I mean, this is where a lot of people are at right now. And so, ideally, what you're going to do is if you want to actually pursue forgiveness, which some people will get this money right now, and then under the circumstances of what they know about their state and what they know about what's going on, they might decide that they don't want to open back up and they don't think they can use the money and they're just going to pay it all back and just pay back the loan. There's going to be some people who make that choice. And then there's going to be other people who are saying, hey, I think that I can get back in operations, within the next month, but I'm going to call back my employees, quote unquote, call them back to work, quote unquote, to work,
Mm-hmm.
but they're not going to work. I'm going to pay them to sit at home.
Okay.
Or I'm going to pay them to do something for me digitally, or I'm going to pay them to do something that's not, within the normal course of business. And it still, fits within my state's rules of what we can do. So this money, they are totally fine with you using it to pay your employees to sit at home. And that's kind of what it was really designed to do.
Right.
It's to get those people who might actually be on unemployment, to get them off of unemployment and have them come and be your employee again. And if they were not on unemployment, then even just bringing them on and actually having them be paid, because this is ultimately not meant to be like a growth package for your business. It's meant to just kind of help maintain status quo, and it's also meant to take the pressure off of the unemployment offices. So um, yeah, I mean, it's not, if you can't open up business back, this is a little bit of a challenge, and it's kind of comes down to the business owner and really what they want to be doing in the long run.
Mm-hmm. And along the same lines there, if they feel like they can bring some people back right now because they have enough sort of that busy work you were talking about,
Mm-hmm.
but maybe start kind of phase people back in. So over the next couple of weeks, rather than bringing everybody back at once, they bring a couple of people back, and then 2 weeks later, they bring more people back, as long as they kind of work up to using as much of that money within that 8 week period. Would that work?
Yeah, this is where we get a little bit. This is where I get a little concerned because the way every ruling that I read, it basically says you can use this money for payroll, but in order for it to be forgiven, you need to spend up to 75% of the loan amount on payroll. Okay, so I'm worried about those people who ramp up their payroll. They are going to have to do planning to figure out if they're going to hit that 75% mark on payroll, because they might get their full-time equivalents up by June 30th like they need to, but I'm a little bit worried about their actual dollar amount. Is it going to hit the limit?
Right.
Because let's say you laid off 70% of your workers because maybe you owned a restaurant, or maybe maybe you had a brick and mortar shop that had to close, and then you were only able to do a little bit of work. And then if you're only at 50% at the time you get your PPP loan, and you can't get those people back on for another month, or maybe you don't even think you can open for another 2 months, your ramp up period, your payroll is going to be lagging, and your payroll costs might not be where they need to be.
Mm-hmm.
So this is kind of where we get into like a little bit of a tricky situation for employers, if that makes.
Because this is another place where the worksheet that we'll show in another slide or two will really help them to budget this out so they can make these plans accordingly, right?
Yeah, yeah. And again, like this money can be used for payroll. It's just even if you go outside of the 8 weeks, it's just then you lose that potential for forgiveness. And so, really this is why the planning piece becomes so important, and kind of why I woke up to it like super quick, because I was like, I need people to know this right away so they don't sit for a couple weeks and then
Right,
eventually get stuck with money that they thought was going to be forgiven.
right, right. Okay. So before we go into this, let me go through it. There's a couple more questions here.
Did you want to speak to maybe full-time equivalents?
Yeah, so full-time equivalents, that would be, so a full-time would be counting at 40 hours a week. So if, so when they're looking at a full-time equivalent, if you have somebody who's working 20 hours a week, that's a zero.5 FTE or full-time equivalent. So really if you're taking your total number of employees and the number of hours they work and multiplying that together and then dividing by 40, which is a full-time equivalent number, and that will give you how many employees you have that are FTEs.
Mm-hmm. And I think some people have asked too, like, well, what if somebody, I had to let some people go in March and I didn't know about the PPP at that point, so I didn't keep them on. And then what if I can't rehire those people? And can I rehire new people to fill their places?
Mm-hmm.
And the answer would be yes. Like we can't force the same people that we let go to come back to us.
Right.
It's ultimately their free will. They can do what they want. And honestly, the hardest part right now, if people are on unemployment and you are paying a lower wage job, is going to um,
Get them back.
trying to get them back. Yeah,
Yeah.
because if they're getting an extra $600 a week on top of state unemployment, because that's the federal the extra federal money, it could be potentially hard to get them back. So
Yeah.
I had been advised that if you were to make an offer to somebody to try to get them back on your payroll, to make sure that it's really clearly documented. And this is where the HR, like I'm curious about how you would recommend people to try to get people back on payroll.
Yeah, and it's interesting because that's actually one of our questions of if people are making more on unemployment than
Right.
they would coming back to work, what do you do? And this becomes from an HR from a disciplinary HR standpoint, I would say, you don't want to make any fraudulent claims with ADD. So if you have offered them a job and they have declined it because they want to stay on unemployment, then you would need to let them know that because you've made them an offer, they're no longer eligible for unemployment and they actually need to come back because as you said before, the whole point of this is to get people off of unemployment.
Mhm.
So I do know that there are some people on the call that kind of waver on best practices, but you need to understand that is actually a fraudulent use of unemployment. So unfortunately, we would have to draw a hard line with that and let people know that if they're being offered a position, even if it's less than what they would receive on unemployment, they need to accept that because they would not be eligible. They won't be eligible going forward.
Mhm.
Once it's reported to EDD or to whoever the state unemployment is, that position has been offered to them.
Mhm. Yeah, I know that it definitely puts the employer in a little bit of a tough situation because especially if they want their employee to do what's best for them, but they also need to be able to like comply with these rules. And you don't want to have to be in a situation where you're audited by
Right.
workers, I mean by the unemployment office, and then get into a situation where it's a he said, she said kind of thing.
Mhm.
So make sure you document your
Oh
offers
yeah.
to people for sure.
Yeah, everybody on this call should know that I always say if it's not documented, it didn't happen, whether it's an
Yes.
email or a written document that you're sending out to them, any type of offer to come back, any type of furlough to go out, and any type of offer to come back needs to be documented.
Mm-hmm. Great.
So, all right, let me see. There's a question about what if all of your employees are part-time and have always been, and that's the nature of the business. So.
I think that just speaks to that full-time equivalent calculation. So you would essentially look at your full-time equivalents before all of this happens. So the guidance says, basically as of February 15th. And then we're going to be comparing that number to the full-time equivalents at June 30th. So there's kind of these 2 points in time. And then I've also seen potentially using an average of January to February 2020, what the average full-time equivalence is. at that point in time compared to June 30th. Because basically they're trying to make sure that you haven't, let tons of people go and just paid yourself a lot more.
Right. Right.
Cut your head count and then like quadruple your own paycheck as the business owner. So they're trying to put some rules into place so that it's logical as logical as it can be to try to just maintain status quo across this time.
Right. One other question about FTEs, and I'm not completely sure on this, so maybe you can speak to this, is if the company as a practice has less than 40 hours as their regular full-time amount, like this company has 37.5 hours per week, are they, do they still use the 40 hours to calculate, or would they use the 37.5 hours?
I don't know. Actually, I don't know if you would do that. I would probably use your full-time, whatever you consider as full-time, to be your full-time equivalent. I'm not sure how many employees we're talking about here. I don't know if it'll be enough hours to really sway the full-time equivalent, because I'm sure there will be like a little bit of rounding that will have to happen in a full-time equivalent calculation. So I don't know if that would really skew it too much, but I would probably use your internal full-time workload to be your calculation of a full-time equivalent.
And I think that's and the 37.5 is a pretty close number to 40. So it's not like we're talking, 25 hours is being counted as full-time. So it will, with rounding, it'll probably be pretty close.
Yeah. I mean, if you had like 100+ employees or something like that, that could definitely skew your number a good bit, but kind of depends.
All right. So do you want to talk a little bit about your spreadsheet and kind of go through some of these cells in here?
Sure. So I'm going to want to use my mouse, and that's not going to help, but that's okay. I can.
I think you can annotate. I think you can.
Oh, can I? Annotate. Or maybe I can even. Sometimes it allows you to. I don't know if I can at this.
Oh, here I can give you remote control.
Oh, well, there we go.
Look at that. Oh, do it. Oh, there you go. Now you have control.
Okay. Can you see my little arrow? Click to start. Okay, there we go. I'm controlling. All right, so this is just a spreadsheet that I put together. This was really as I was thinking about my clients and knowing that people were getting approved for these loans, I was thinking about this challenge of needing to fit these costs within a short 8-week timeline. And because it is short, it doesn't give you a lot of flexibility, and you can't defer these loans. That's the other issue too. The banks are required in the ruling to fund the loan within 10 days of the documents being approved. So and most of them are doing it in 2 to 3 days, sometimes less. So, and then some of them, you don't even sign documents. I think Chase has just been like depositing money without even going through like a loan, even having, to do like a DocuSign or anything like that. So this money is getting into people's accounts quicker than we probably would like in some cases. So I wanted to make sure that we budget for it so that we can kind of maximize forgiveness. So the way that I've set this spreadsheet up is that you have to reach 75% of your loan amount in order for this to tell you that it's forgivable, because that's how I understand the rules, and that's how other people are understanding the rules to be working right now. So what I would do up here is I've let this cell up here, you type in your total PPP loan. Okay. So if you've already gotten some sort of documentation saying what your loan amount is and you've applied for it and it's here, you can put that number in there. And so this is just a calculation that says, hey, this is what that number was based on, your average payroll cost. Once you fill this number in, this and this both fill out. So this minimum payroll is 75% of this number here. And then what I've done here is I've put this situation that helps you think about, okay, what do I need to budget in order to, or what do I think my budget is over the next 8 weeks so that I can plan for this? And so I might think, okay, my average payroll is about 22,000 each time. So I'm going to type in 45, and I know my health insurance is 5,000 a month. So I'm going to type that in. I know my retirement contributions. And you kind of type these things in as you know, and your rent is 5,000 per month, and all these numbers I've just plopped in here as an example. And then utility costs. Okay. And so then when we get into this, what I want to do is I actually want to say, okay, what day does my payroll come out? And actually put in the number that I know my payroll is going to be. And I know my payroll is going to be, or maybe I know I need to hire more. So I need to start planning out what I need my payroll to hit in order to reach these numbers. So it's all summed up over here. This column is the sum of all of these. And the sum of payroll, health insurance, retirement, and other payroll costs, all of these columns are summed together to determine whether or not they're more than this minimum payroll amount here. Okay, so it's going to say, okay, 51 plus 10 plus 4, is it more than this? Then yes. And then it's giving you a calculation based on this. If all of these allowable costs are more than the loan amount, then the total loan amount is forgiven. Now, if you didn't have any rent and you took this out altogether, then your total allowable cost would be less than your loan amount. So you would have a remainder here. So this is a little bit limited and just pointing this out. It's a little more dynamic when I can actually play in the Excel thing, but I did create a YouTube video where I walk through this pretty clearly. So if anybody's interested in that, we can send that out in the resources afterwards. But this is available for download just for quick and easy. So you don't have to create it yourself. And you do want to type in your actual date that you get the loan in here so you can understand the start of each of your 8 weeks here. So I think I covered most of that.
Yeah. So, and I think that that also answers a couple questions. I'm going to take control back of my mouse here so I can check our questions. But there's so Makia asked about keeping track of spending. So this is definitely a way to do that.
Mm-hmm. Yeah, with keeping track of spending, you definitely want to keep any sort of documentation you possibly can. Especially around those other allowable costs. So payroll costs, you'll be able to use your payroll reports from your payroll provider. Health insurance, you would want to get your actual bills that you're paying and the contributions that you're making. And the same with retirement contributions. You'll get some sort of receipt every time you make those retirement contributions. You really want to be documenting anything that you do to spend this money right now. And I come from an audit background. So with audit, you need a document proving that you owe the money and then a document showing that you paid the money. So with a utility bill, you want to see that you have a bill and then you want to see that it came out of your account, or you want to see a check that was cleared that paid that bill. So you want to kind of see two sides of it.
So, so one thing in terms of best practices is all of these bills you're talking about, and making sure you have a folder wherever you're storing your electronic files, and just keep all of these bills together so that when they come and ask for the backup, you have it all in one place.
Exactly.
Just
yeah, and some banks have advised keeping things in separate, keeping it actually in a separate bank account. I feel like that is a little overkill if you don't have good documentation practices, but my assumption is that most people probably on this call are probably a little above board on documentation. So probably don't need the separate bank account if you think you can handle it otherwise.
Okay. All right. So I'm going to skip over the ERC for just a minute because I'm seeing a lot of questions about the EIDL and the grant for that, and I want to make sure we get these questions answered because we have about just a little over 10 minutes left, and
sure.
And if we do have time, we'll go back to ERC.
Okay.
But so just as an overview, as I said, they are funding more in the EIDL or the EIDL loans. You can get up to $2 million in financial assistance. They're starting with a $10,000 grant that is forgivable. And this has, if you do end up getting a grant, or you do end up getting a loan, or part of your grant is not forgivable, then the repayment of this would be over 30 years, and it's a very small interest on that. So this is another option. So maybe speaking to, first of all, I know that as of right now, when I looked on the SBA website, they are not accepting any more applications for EIDL. But for people that have not received anything, and this was like, talk about a black hole. This was you submitted it and then you never heard anything. And I think one Saturday morning I woke up and I had money in my account. I was like, oh, well, I guess I got my EIDL loan approved. So do you have any insight into if people haven't received the funding on that, when they might expect to see that, or do you think that this new round will basically try to pay those $10,000 grants as much as possible going forward, or what's your thought on that?
Yeah, so what I've been seeing from people who have gotten this money, or at least the grants are basically based on whatever number you put in your number of employees box. So if you put that you had 8 employees, then you would be basically potentially eligible up to $8,000 for a grant. But this has been very, very, it seems willy-nilly. I don't know who got it and who didn't and why they got it over somebody else. But yes, money just shows up in your bank account someday if you've checked that box that you wanted the $10,000 grant. And it is, if you receive that money, it does offset your potential forgivable amount of your PPP loan. So somebody specifically asked the question, if someone receives a PPP loan of $75,000 and the $10,000 grant of the EIDL, how much is forgivable? A total of 75 basically is the answer to that, because if you used your PPP money and it was 100% forgivable, it would still have to be offset by the fact that you already got $10,000 of that grant, or you got the grant for the $10,000 and it offsets your amount. So there's kind of, they don't want you double dipping here. So you would have to pay back you would essentially have to pay back $10,000 in that specific example.
Okay. And so with that, would you have to pay it back? Like, how do I ask this question? Can you choose who you want to pay it back to? Because it's different terms,
It would,
the PPP versus the EIDL loan.
yeah, no, that's a good question. From my understanding is that it would just reduce your PPP because you probably got it second. But, and then we would not really know, like my guess, and this is a guess, I'm going to just totally disclaim that this is a guess, but when we actually go to apply for forgiveness, is that we'll probably have to put in the PPP application for forgiveness, did you receive an EIDL grant? If so, how much? And then you'll put that number in there and it'll likely just decrease your amount of forgivable amount. So my guess is that this will go into the EIDL. Now the EIDL has a 1% interest rate. So the PPP has a 1% interest rate and the EIDL loan has a 3.75 interest rate. So it's a little bit more favorable from an interest rate perspective to have it be in the PPP side.
Okay. Let's see. So we talked about the EIDL and PPP and being forgivable. Do prepay expenses such as rent count towards your forgivable?
I don't think you would be able to prepay them more than 2 months. So, or like you would only be able to have 2 months covered during the period. So now maybe you had already paid your April rent. So maybe you want to go ahead and pay May and June in your 8 weeks. But you're not going to be able to like pay 6 months of rent to reach your 25%. I think that would probably be disallowed.
Okay. And then one other question about the EIDL is, if they actually got their EIDL loan, not the grant, but their actual loan, how can they use that money?
Yeah, so one of the things with the PPP and the EIDL together is that they need to be used for separate purposes. So what I've seen people use them for is you could use them for consolidating outstanding debt. So if you had debt sitting on your balance sheet that was, maybe you had some equipment loans that were kind of higher percentage rates, or maybe you had a, line of credit that was at 5+%. I mean, even if I was at 5%, that'd be a good interest rate. But if maybe it's sitting at like 7 or 8%, you could basically use the EIDL loan as a way to consolidate your debt. I'm recommending some people do that. Some of my clients that are kind of working through that. You could use the money and just have it sit on your balance sheet as extra cash for the future. Maybe whatever happens down the road, maybe after June 30th. So after your 8-week period is over, then you can use it for payroll. What they don't want you using it for is payroll during your 8-week period that the PPP is covering.
Right.
These loans are supposed to be used for different purposes, but they can be used for kind of the same purposes as long as it's a different time period. So down the road, if you use it like in December to cover payroll, that's fine. That's up to you. But a 30-year term, like this is a mortgage basically is what they're giving people.
Right.
I mean, it's 3.75% at 30 years. This is basically a mortgage. So
Right.
it is a very good term for right now, but I don't recommend anybody just holding on to tons of debt just because. So, I mean, this is something for you to think of as an organization and what's the best use in the long term for you guys.
Okay. All right. Well, I think we've made Makia very happy.
Yeah,
So,
well, I mean, honestly, I've had some clients that had credit cards, $60,000 in credit card debts at 15%. So if you're able to, move that to a 3.75, I mean,
right.
that's great. That saves you that saves you cash flow right away, just not having such high interest payments.
Yeah, definitely. All right. So we have just a couple minutes left. So do you want to talk about some things that you have available to our listeners if they would like to, if they'd like to engage with you?
Yeah. So, I mean, first, I just want to be able to make sure that this spreadsheet is available to everybody. I have an easy download link that you can get it and customize it and use it how you want to. If you, I put this example in the first tab, and then the second tab of the worksheet has a blank one just ready to go for you to fill out. And then if you wanted some help and you wanted me to specifically help you, if you don't have a CPA or somebody else on your team that can help you with this, I do have strategy sessions. So it's just one-time calls that you can book with me at any point in time. I do 30 minutes, 1 hour would be plenty of time. 30 minutes or an hour is usually enough time. I also have a 2-hour session if that's something that somebody wants to go through, maybe more than just this spreadsheet with, but I'd be happy to talk to any of you. This has been really fun.
Yeah, and I kind of have a standard link that I set up. So I did set up one that takes you directly to Hannah's worksheet. So you can go to go.eoshr.com/ClaraCFO, and you can download the PPP budgeting worksheet, as well as be able to, from that worksheet, you'll see at the top of the screen there, it says book a call with Clara CFO. So that will be available to you. And then, as always, I always want to remind everybody that that the even though we may eventually get to go back outside, it doesn't mean that the coronavirus is gone away completely. And there are some policies that are required for employers once you have your employees back at work, especially. And these are the FFCRA, Emergency Paid Sick Leave, and Emergency Family Leave Act policies that you need to have through the end of the year. So if you want to take advantage of that, we are still offering that at $99. And you can purchase that at go.eoshr.com/COVID. Before I finish up, there was one last question that snuck in here.
Mm-hmm.
If you get the EIDL, then you don't need to try to spend all of the PPP and amortize the balance that isn't forgiven. Is that correct?
If you get the EIDL. I'm just trying to make sure I'm understanding that. Amortize the balance that isn't forgiven.
So I think if you're not using all of the PPP money, you have to use the PPP first for payroll expenses. if you're using the EIDL for expenses during that first 8 weeks, they would need to be non-payroll expenses. Am I saying that correctly, Hannah?
Yeah, I think I'm not getting how the thing is trying, what they're trying to get at. So, sorry, that's.
Well, I'm not sure who this is, so if you want to type or re-clarify your question and type it in, we can stay on just a few minutes longer. But I just want to wrap up and thank everybody for coming. We are having, we're going to join together again in a couple weeks for our next HR Power Hour. We'll be talking about getting back to work and some of the things to think about as you're going back to work. And so you can register for that at go.eoshr.com/back2 and work. And that'll be Friday, May 8th at 3 p.m. And also I'll be sending out some information. Laura Renner and I are continuing our Remote Strong series, and that will be next Thursday at 11 a.m. So hope to see you on one of those. But whoever it was that asked the question about the EIDL, if you want to re-ask that,
or send me an email, hannah@cfo.com. I'd be happy to respond in an email. So
so here's our contact information. You can go to eoshr.com or claracfo.com, and we are happy to answer any questions for you. Thank you so much for joining us. Have a great weekend. Enjoy the sunshine and stay healthy and safe, everybody.
All right. Thank you, everybody. Bye.